S&P is up 27, 28%, but if you look at it versus September of last year, it's up only 7%.
Right.
So I think it's really up only in the last few months. And I think that's largely on account of easier monetary fiscal policies that are starting to kick in, and then obviously the trade optimism. But I think for next year broadly, we do see more upside as the business cycle basically shows more signs of reacceleration. And we do think that the rotation that began at the beginning of September continues to move forward towards the cyclical trade.
What do you think of the economic picture, though, here in the United States? Do you have a good read? You feel like you have a good read on that? I mean, there's seasonal distortions, which people are flagging. The claims number today was not good. What do you make of it? How do you even factor that in?
I think when you look at claims, even our economists are talking about it. There's a lot of these seasonal effects that create volatility on a short-term basis. But I think bottom line, labor market continues to be pretty strong. The consumer is in pretty good shape. I mean, if you look at the job numbers that came out just recently for the last month, they were pretty strong. Participation rate is actually moving slightly higher. Wage growth, you're seeing a little bit. So I think I think the U.S. consumer, the job market is one of the positives within the, not just U.S., but global economy.
When you were here last a few weeks ago, you talked about the economy improving globally. And as we discussed, we really hadn't seen many signs of it, right? And in fact, some signs are going the other way. Are you seeing that now? I mean, it's only been a few weeks. And what's going to be the catalyst for it? Rates are actually moving higher despite easy money policies. So I'm cautious about that myself.
I mean, rates moving higher, I mean, obviously different drivers, but at least the way we're seeing it, rates moving higher, a lot of that I think is also a reflection of expectations of better growth in the future and maybe a little bit of revivement on the inflationary side. We do look at a lot of data. I think internationally, specifically when you look at Asia, a lot of our indicators continue to point up, not just China, but when you look at a lot of second derivative plays around China like Taiwan, Europe, things are extremely bad, and I think they're getting a little bit better than expectations. And so, again, yes, the level is still depressed, but I think it's the second derivative effect that continues to show signs of life.
Dubravko, how much of China's stimulus, as they've been fighting all year against the trade war and trying to, whether it's lowering reserve requirements down substantially or whatever it might be, how much of that is going to start pouring through to the rest of the world? Because this is a connected world. So China can put up all kinds of stimulus, and if any of these tariffs come off, doesn't that provide a pretty significant pop to the rest of the world?
For sure. If you see even a partial rollback, to me that equals basically a positive base effect. And that's going to get manifested through basically healthier margins. We basically estimate that the cumulative negative impact of tariffs alone for S&P EPS, S&P took about a 7 to 8% hit from a growth potential this year. So instead of having a year where we printed 8%, we're looking at maybe 1%. So you get any portion, even any partial rollback, I think that creates this positive base effect. Obviously, U.S. benefits, but so does Asia. And I think the fiscal and the monetary policies, I think you're seeing some benefits already, but I think more of that will be visible as you go only in the coming quarters for 2020.
Would you be very negative if we got the bump up in tariffs? What would that do to your outlook?
Absolutely. Absolutely. That's a game changer. I think then that suppresses the cycle, and a lot of this reacceleration that we're starting to see gets reversed.